All right. Hey, good morning, everybody, and thank you for taking the time to call in live, and we'll jump right into it. I know most people are busy this morning. They're out. Everyone is gearing up for a busy day outside before it gets um, too unbearably hot. So I'll try to keep the background noise to a minimum and make sure uh, that the recording is clean for everybody that's going to watch it. All right, so let's jump right in here. Um, Before we jump to the charts, let's go through a few of the things that are driving us fundamentally, and then what we're going to end with are good to excellent ratings. And I want to talk about two different schools of thought on good to excellent ratings, and I think that will illustrate why we're getting such a wide variety of yield estimates that are out there, right? Because we're in the time of year when we focus on supply, but that time is coming to an end, and we're getting ready to transition back to demand and more global supply. But for today, weather is front and center, right? So let's just kind of go through a couple of things. First of all, the South American crop and the South American situation keeps getting worse, not better. The demand side continues to look bright for the U.S. I have no idea what the exports are that are supposed to come out here at 7:30 this morning, but seasonally, this is kind of the slow time of year for corn exports anyway. So I don't think anyone's expecting us to blow the roof off of exports in July. That our time in the sun starts to shift again back to us here as August begins. But it's safe to say that the South American crop is small. The Ukrainian crop isn't great, and there's no new supply coming into the world except for what we're growing here. So the focus really has to be on what our yield is. Now, we keep hearing more talk about demand destruction. Have we gotten high enough to blow up demand? Well, ethanol is really what they're talking about. Have we gone high enough to make ethanol unprofitable? And with oil sell-off this week, ethanol has taken a hit on its margins, but it's not unprofitable, and it's certainly not to a point where they're going to stop grinding it yet. But we do need to pay attention to that, right? If you're working in a spread industry where you're buying corn and you're turning it into something higher value, then you can collapse that spread by reducing the price of gasoline, or you can collapse that spread by increasing the input costs, right? And high corn hasn't slowed us down, but low oil might. The other thing that everyone is talking about that could be a black swan is, are we going to go back into lockdowns? Is this Delta variant so powerful and so strong that it's going to shut us down and cause us to repeat the spring of 2020 again? I don't know any more than anybody else does there. I hope not. I hope that we can just work through this thing on our own, and we don't have to have Big Brother telling us what we can and can't do again. But I guess we'll just stay tuned. I don't think that the political winds are really leaning that way. I think there's some noise in the background, like Apple saying, "Hey, we're not going to go back to work." Will other companies follow that? Will kids have to wear masks in schools? All those things could be negative for demand, so we'll just have to keep an eye on it. But for now, I don't see anything there that's shifting or going to change the market at all. Okay, so let's talk about the news that broke yesterday, where senators from the oil states proposed that they eliminate the ethanol mandate. And it was I forget the names of the senators, but there's 4 of them that signed it. California, Feinstein signed onto it, and so did a couple others from the eastern oil states that have been battling these RFS waivers for quite some time. I think it has zero chance. I did quick count of the ag state senators, and I got to 36 very hard, solid no votes on that. And I think that number is going to get above 51 real fast. So I would be surprised if that goes anywhere and even comes out of committee, to be honest. Okay, yield. So we're reading lots and lots of talk about national yields getting back up above 185 and that we're actually going to break trend line yield. So I want to talk through that here for a few minutes, and then we're going to dive into the charts. So there's two schools of thought here, okay? And everybody knows that I tend to lean to the bullish side of things, particularly this time of year. And I admit that freely and voluntarily. So we spend a lot of time trying to look at the other side of the coin and understand the bearish argument. So what is the bearish argument for higher yields when we've had the weather that we've had, right? Really, really wet in the east and really, really bad in the west. So what is it? Well, if you look at things this way, then I can understand an argument here. So we all know what trend line yield is, right? You have a trend line that starts at the lower left of a graph and it moves up to the right. And that trend line yield for this year is about 179.5. If you look at good to excellent ratings and you just compare them to a simple 10-year average at the end of the year, okay, so we're in week 28, I think, and if you compare it to the end of the year, which would be like week 37, if you take the 10-year average on week 37 and compare it today, we're actually 1 point higher than the 10-point average on a national good to excellent rating. All right, so 1 point higher. And then on top of that, your poor to very poor on a 10-year average as of today is 3 points better than it has been over the last 10-year average. So your poor to very poor is 3 points fewer, and your good to excellent is 1 point higher. And so that's your argument for why we would get a higher trend line yield. Because if your good to excellent ratings are the same every year, then and the trend line is coming up, then your yield would increase every time. And if you're above on the good to excellent ratings, then you should see a higher weight given to higher yields. So that's the argument that they're making, is that if trend line is 180 and we're slightly above and our problem spots aren't really that bad, then we must be above trend line yield, and therefore our supply is more like 182, 181, 185, somewhere in that neighborhood. Okay, so I can see that, right? If you're not thinking any deeper than that, and you're and that's just what you're looking at, then I think that there might be some weight to that. But if you roll things back to where we are and you compare apples to apples and you compare good to excellent ratings against the prior record yield years and where we stand, and we are 15 points below year to year in 2021 than we were in the prior record yields of 2018. So we are 15 points below that. And I'm going to read you some numbers here because I think it's really, really helpful. Iowa, in 2018, on our record production year, Iowa was a 78% good to excellent. This year, we're 68, 10 points below that. North Dakota, 88 in 2018, and we're at 29 today. South Dakota, 69 in 2018 and 30 today. Minnesota, 77 in 2018 versus 42 today. So the good to excellent ratings aren't just off what they were in 2018. Guys, they're less than half. They're terrible in those states. The problems that we're having in that area are extreme and severe. Now, the East is going to make up for it, right? That's what they keep telling us. So Illinois, 80% good to excellent in 2018, 65 today. It's actually worse than it was. Indiana, 72 back then, and we're at 73 today. 1 point better than it was. Nebraska, 86 in 2018, 78 today. Ohio, 81 versus 75 today. Guys, we're worse almost all the way across the board, even in the East where the weather's been fantastic and the rain has been great. And we're a full 15 points worse on corn than we were on our record yields. So how do you get to a record yield in that instance? Because we all know that what we tend to do from here is we tend to peak around the mid-July and then we start to slide off and we tend to make it worse. So pick your coin, right? Which side do you want to bet on? Heads, the 10-year average, good to excellent, or do you want to bet on the on apples to apples best crop year to today? I don't know which one it's going to be, but I know that one of these lines up with the chart formations and the other one doesn't. So let's take a look at the weekly charts first. Where is my weekly chart? Here we go. Okay, here's our weekly chart first. We talked about this and just a little bit about how we view time frames, okay? Because we jump from weekly to daily to 4 hour to 1 hour to 5 minutes, right? We watch time frames all the time. And here's a rule in trading that will save you an awful lot of money and losses if you'll adhere to it. Higher time frames, greater weight. Lower time frames, least weight. 5-minute charts don't matter in context of a weekly chart, okay? So here's a weekly chart of December corn. So we know that markets tend to move in waves, 5 waves, right? You have a 1, a 2, which would be followed by a 3, and then a 4, and then a 5. We're in wave 2, and I think we just completed it when we start looking at the shorter term structures. So Fibonacci retracements, we held at 50% off of the peak move, and we're now turning higher. This is a bearish, what we would call a bullish engulfing shadow, or a bullish shadow here, where we're rejecting lower prices and starting to work higher. And everything on this chart looks phenomenal, and it looks like we're getting ready to blow out to new highs. What might cause that? Well, before we go to the daily chart, what I want to show you is this graph, okay? So if you look at the 6 to 10 day forecast and even the 1 to 5 day, what you're looking at here is the D1 drought areas, and you're looking at the projected rainfall. So in these areas where we're rated 20% good to excellent, right? 30% good to excellent, 40% good to excellent, where we're between a half and a third what our normal average ratings would be. We're looking at almost 0 rain for the next 10 days. On top of a heat index, here's our heat index that is extreme. Here's our temperature index. We're setting up this heat ridge, so we have no moisture in any of the drought areas with extreme heat for the next 10 days. And we're not talking just a little bit of heat, right? We're talking 15, 17 degrees above normal in some of these forecast levels. So now I don't know if that's going to materialize or not. I don't have any idea, but I know that I'm not an agronomist, but I know that's bad, right? I know that 100-degree heat, as you're trying to fill kernels and complete ears, is not adding test weight and it's not adding yield, right? I know that. A good example I heard several weeks ago is, hey, your plants in your garden look really, really good, so turn your water off, go on vacation for 2 weeks, don't water it, and let it go through 100-degree heat and come back, and how's it going to look, right? Well, it's going to be dead. So that's what we're dealing with. And so when you look at the forecast and you put a little bit of thought into it, which narrative do you want to subscribe to and put your money behind when you're looking at good to excellent ratings, when you're looking at demand, when you're looking at South America, when you're looking at weather shifts? The bearish argument is weather's going to be good, demand's going to be bad. Well, those are based on assumptions and hope that something changes and that the trends go away. And what I'm learning more and more about weather is that the trend is sticky. It's your friend, right? It's really hard to bust these patterns, and there's nothing on the horizon that would suggest that. So the narrative that I think best suits a farmer, somebody who has his economic um, uh, future riding on the price of corn, I think the narrative is you got to bet on higher prices here because we're getting ready to cook, upwards of 2 billion bushels in the Northwest Corn Belt. We're going to cook it for the next 10 days. And until that changes, I don't see any reason to change positions. So now technically, how are we set up here on the daily chart? Okay, we talked about the weekly. You know what the bias is. This wins from a bias standpoint. So what we're looking for on the daily charts is something that would be bearish or something that could blow that up. So what we've got is this huge wedge sitting right in here, okay? So we've got this wedge that started on June 10th and has been ongoing with lower highs and really a pretty stable floor down here. So you've got this wedge and you've got this gap that's open right in here. It looks like we're going to fill this gap today. I'd be surprised if we didn't. A very common and popular trade setup is to fade this. So you would sell as the price gets into the gap, and then you would put a stop somewhere up in here. I would probably put a stop right up in here if I were going to short this. And if the weather was bearish, like if we had great rains forecasted, and normal temperatures and great rains and we had really good to excellent ratings, I think we'd probably look at selling this on the daily chart because it doesn't look that bad from a short if this is your only perspective. But when you put it in context of the weekly, I wouldn't sell that with anybody's money because the risk is just simply too great that we rip up out of here. I would much rather wait to sell it until these lows down here all get broken and we start to move lower because you got to give deference to the macro trend on the higher time frame, okay? So what are we looking for? We're looking for this gap to fill. We're looking for a challenge of this 588 to 595 area right in here, which would be the top of this little red bar down to here. Looking for a challenge of that, which would also be the challenge of this downward slope. I would expect it to fail there and come right back down. And then I'd expect it to challenge it again and break it. And unless we end up with some sort of a weather forecast or we do go into lockdowns or something else, then we turn around. So I think on this move higher, we'll probably roll calls that we have that are in the money. We'll probably roll them up. I'm absolutely not interested in dumping cash at this point because I think we're still in a position where we can work much higher. And I think beans are even more bullish. Okay, so that's enough on corn. I think we're gonna challenge 590. I think we're gonna run into a little bit of trouble and it's gonna scare people, but I think that's just a little pullback into a much broader uptrend. And I think you got to be looking to re-own it if it comes back down and tests this 560 area because I think it's going to be pretty powerful what happens next. Okay, soybeans. Soybeans are I think even more bullish than corn. These yields that we're looking at, good to excellent ratings. We're a solid 16 points below on good to excellent ratings, and we're below the 10-year average on those. So I don't think that the narrative is there like in beans like it is in corn, but we know that August is the critical time frame. And guys, the first part of August is turning out to be really dry, and you look at the extended forecasts and the weather trend doesn't look to be changing anytime soon. So soybeans, what are we looking for in beans? We're looking for a challenge of this 1422 and then likely on up to new highs, probably sooner rather than later. If for some reason they turn around and start working lower, I'm looking at 1360, which would be this cloud level here, 1360 to 1350 as a warning signal. Because if we break that, we could come lower technically. I don't know what would drive us there. Probably a shutdown or some sort of a COVID-related event. So I would try to defend this level, 1350, 1360 on November beans. We want to see that hold, and we should work up and out of here from there. All right, last but not least is wheat. Wheat is starting to pick up its narrative. You know, it's the spring wheat crop is terrible. It's a total disaster, and so it's going to ration prices. I think it's headed towards 10.50, $11. I think Kansas City's going to go with it to some extent. You know, you look at the weekly chart on Kansas City, and it looks really good. It looks to us like we can close above 671. There's really nothing between here and 750. This $8 target is realistic and is something that we should keep our eye on. So at this point, we're not going to get there in a straight line. We're going to have a couple of oh my goodness days where oh my goodness we missed it, right? But I think the trend is rebuilding. Again, you got a 1 and a 2. So every chart we have has a 1 and a 2 in a longer term 5-wave structure that leads and resolves itself to the higher side. So I think patience is yet again the narrative on July 21, because we don't see anything that changes our tune on any of these grains. We got to stay in them and let the market do its job. All right, I hope that was helpful. Please call me. Please, happy to have these discussions with anybody else and give you more information on where we get our sources and those kinds of things. Remember, there is significant risk in trading futures and options, and you should only do so in light of your own financial condition, and always consult a professional before you make any trades. I hope you have a great week. We will talk to you next Wednesday.